and welcome to the National Real Estate Post here. I am Frank Garay to get you informed. Two things before we get started. Number one, Angel Oak, we're doing another webinar. If you got borrowers that might have a little bit of beat up credit, might not have a whole lot of money to put down, these guys have solutions. The last webinar we did was awesome because we went through lots of scenarios. So if you've got any scenarios that you want to run by these guys in a live setting, I suggest you make it to this webinar. It is February 8th, so there's plenty of time. Click the banner you see right here on your screen over on your right to register, and we'll see you there. Don't miss it. It's going to be a great webinar. And also, Loan Officer Freedom Podcast with Carl White. He uploads new podcasts about every week. It's absolutely free, and he has these top producers on there that are telling you how they're doing it. And for free, why wouldn't you sign up? I mean, it's super cool. Click the Loan Officer Freedom banner you see on your screen right here over on your right. You might have to scroll down a bit, but go over there and register for free. You're going to love the content that Carl's putting out. Now, let's get on with the show. A few things to report today. Some interesting, some not so much. And first off, let's start here with something that, I don't know, it's kind of interesting, but to me, not so much. It looks like there's an agreement in place now that allows the GSEs, that being Fannie Mae and Freddie Mac, to keep a $3 billion cushion for themselves instead of sweeping 100% of their profits to the Treasury. Okay, the $3 billion capital reserve can be used as a cushion against expenses should they occur, such as the change in the corporate tax rate and the zero capital mandate that came about with our new tax reform just this month. The new agreement is being viewed as a win-win, according to Jim Vogel, an analyst at FTN Financial, and he's quoted in a Housing Wire article as saying, "Bottom line, this agreement delivers an acceptable win for both sides. FHFA gets some capital flexibility and reduces the potential headache of GAAP earnings fluctuations that could cause unnecessary, annoying draws that are likely to be repaid shortly thereafter." He added, "Treasury moves this 2-year nagging issue off its agenda and gets to focus on newly stirring congressional efforts at GSE reform in 2018. In other news today, DS News is reporting that HELOCs, this would be your home equity line of credit, the rates on these loans could jump up to 75 basis points in 2018. The reason being is that most HELOCs are adjustable rate loans tied to indexes that are directly affected by the Federal Reserve's rate hikes, which are anticipated to continue to rise in 2018. So here's my thoughts on this, and this is the one that I think is kind of interesting today. So you've got pretty much a guarantee that HELOC rates are going to go up this year, and the interest on these loans are no longer a tax deduction. Couple both of these facts with a lack of housing inventory, which is forcing home values even higher in 2018, you may be able to actually do some refinance business for your past clients to pay off these HELOCs. I mean, even if first mortgage rates continue to move upwards, it still may be more beneficial to do the refinance of both the first and the second to lower the total payments and be able to get the mortgage interest tax deduction on the higher loan amount on the first mortgage. It's just a thought, man. So you may want to farm your past client database if you're a loan originator out there, letting them know that HELOCs are anticipated to rise and to call you if they want to look at a total refinance to get back that mortgage interest deduction and possibly lower their overall house payments. And finally, cryptocurrency is again in housing news. Our friends over at National Mortgage News posted an article titled, "Could Blockchains Replace Banks in Real Estate Lending?" Well, the article opens this way. The startup Propy recently sold an apartment in the Ukraine through its blockchain, and in the last week of December, it began letting Californians buy and sell properties on its blockchain using Bitcoin. Okay, so what does this mean? A blockchain is the world's leading software platform for digital assets. In other words, it's kind of like a bank for cryptocurrency. It's an open, distributed ledger that can record transactions between two parties efficiently and in a verifiable and permanent way. Once recorded, the data in any given block cannot be altered retroactively without the alteration of subsequent blocks. So basically, the blockchain could replace a bank when using cryptocurrency. Huh. Hey, you want to hear something even scarier? The article goes on to say this. At some point in the near future, Not only real estate transactions, but mortgages themselves may be handled on a blockchain. And banks, they will have to adapt. I gotta ask you, does this stuff freak any of you guys out like it does me? I mean, I'm feeling like this cryptocurrency is taking over and taking over fast. I mean, is the US dollar gonna be worthless like next year? Should we all be running to Bitcoin? Are those of us who don't quite get it gonna be staring at ourselves dumbfounded and penniless and homeless because our money's useless in the immediate future? I mean, I don't know, but the whole thing is freaking me out. Your comments on this show are very welcome, as I think if you're one of the people that are in touch with this new way of doing things, I mean, if you could let us know what we should be doing right now in the comments, that would be really great. Well, you all have a fabulous day. It's good to be with you here in the new year, and we'll talk to you tomorrow at the National Real Estate Post. Forward, share, subscribe, comments, adios.